Hello everyone, welcome to the market opening bell on Tuesday, March 11. China's inflation data for the previous month came in below the expectations, leading to a pullback in Hong Kong stocks on Monday. The Hang Seng Index opened 115 points lower, briefly rose by 61 points to 24,292 in the early session before retreating and fell as much as 598 points in the afternoon to a low of 23,632. It closed the day down 447 points or 1.8% at 23,783. The H-share index dropped 189 points or 2.1% to 8,725, while the Hang Seng Tech Index fell 151 points or 2.5% to 5,885. The total market turnover for the day was 301.8 billion Hong Kong dollars. In the Shanghai and Shenzhen stock markets, stocks rebounded with volatility near the close, narrowing the losses slightly. The Shanghai Composite Index closed at 3,366, down 6 points or 0.19%, while the Shenzhen Component Index closed at 10,825, down 18 points or 0.17%. The combined turnover of the two markets reached 1.6775 trillion yuan. The midpoint exchange rate of the Chinese yuan against the US dollar fell for two consecutive days, hitting a one-week low of 7.1733 to $1. On the Hong Kong stock market, southbound funds net purchased $29.6 billion worth of Hong Kong stocks yesterday, setting a record for the highest single-day net inflow in history. This included net purchases of 10.4 billion Hong Kong dollars in the Tracker Fund, $5.534 billion in Hang Seng China Enterprises, $2.918 billion in Alibaba, and $2.043 billion in Tencent Holdings. According to statistics, southbound funds have been net buyers of Alibaba for 19 consecutive days, totaling 63.1 billion Hong Kong dollars. However, Alibaba still fell 5.5 Hong Kong dollars or 3.9% yesterday, closing at $134.5. Baidu, following its recent issuance of 10 billion yuan in senior unsecured notes denominated in Chinese yuan, has announced plans to issue up to 2 billion US dollar, approximately 15.6 billion Hong Kong dollars, in exchangeable bonds due in 2032. These bonds are planned to be exchangeable for shares of Trip.com Group held by Baidu. It's estimated that Baidu may use the proceeds to repay part of its existing notes, including 500 million US dollar in 10-year notes due in June 2025 and 600 million US dollar in notes due in April 2026. Additionally, some of the funds might be allocated to increase share buyback, with 3.3 billion US dollars still unexecuted from its 5 billion US dollars share buyback program, and potentially to expand capital expenditures. Baidu's founder, chairman, and CEO Robin Li revealed that Baidu will further introduce a 30,000 card P800 cluster in the future, providing robust computing power support to the industry while reducing the cost of training large-scale models. With the iterative advancement of large model technology and a significant drop in costs, and explosive growth in artificial intelligence applications is expected. The share price of Mi-Share Group, a newly listed stock, continues to hit new highs, rising 10.8% throughout the day to 393.4 Hong Kong dollars. However, Mi-Shares Tea, which also belongs to the tea beverage industry, issued a profit warning and was removed from the Hong Kong Stock Connect, causing its share price to plummet by 20.7%. Shares Tea expects to record revenue of approximately 4.8 billion yuan to 5.1 billion yuan in 2024, a decline of 1.2% to 7% compared to 5.164 billion yuan in 2023. It also anticipates an adjusted net loss of about 880 million yuan to 970 million yuan in 2024, compared to an adjusted net profit of 20.912 million yuan the previous year. The shift from profit to loss has been attributed by nitrous tea to a sluggish consumer market and intensified industry competition, which have led to fluctuations in store revenue and operating profit margins. Under the pressure of heightened industry competition and market conditions, nitrous tea has had to slow its expansion pace and close some underperforming stores. The increasing involution, which means intense internal competition within the industry, has triggered a wave of closures. According to statistics, as of February 15 this year, 143,500 new ready-to-drink tea stores opened over the past year, but the net growth was negative at minus 8,056 stores. Meanwhile, the density of ready-to-drink tea stores continues to rise, with 30.53 stores per 100,000 people as of February 15, up from 29.31 stores per 100,000 people on September 15 last year. Trump stated that the US economy is undergoing a transformation and did not rule out the possibility of a recession. Investors' concerns that his policies could lead to an economic slowdown intensified, causing a sharp decline in US stocks on Monday. The VIX index, known as the fear gauge, rose by 4.5 points or 19.2% to 27.86. The Dow Jones Industrial Average fell by as much as 1,000 points during the session and closed down 890 points, a 2.08% drop at 41,911. The S&P 500 index closed down 155 points, a 2.7% decline, marking its largest single-day drop since December 18 last year, ending at 5,617. The Nasdaq Composite closed down 727 points, a 4% decrease at 17,468. The Magnificent Seven tech index fell by approximately 4.7%, representing a nearly 17.5% pullback from its closing level on December 24, 224. Among them, Tesla dropped 15.43%, its largest single-day decline since September 2020. Nvidia fell 5.07%. Apple declined 4.85%. Alphabet dropped 4.49%. Meta fell 4.42%. Microsoft decreased 3.34%, and Amazon slipped 2.36%. Additionally, AMD and TSMC ADR both fell around 3.6%. The Nasdaq Golden Dragon China Index closed down 3.5%, with Bilibili dropping 9.4%, Alibaba falling 5.8%, Li Auto, Xiaomi, and Tencent declining over 4%, and JD.com and Pinduoduo slipping more than 3%. On the economic data front, the U.S. Conference Board Employment Trends Index, ETI, fell from a revised 109.45 in January to 108.56 in February, the lowest level since October last year. This reflects how growing policy uncertainty is beginning to drag down business and consumer sentiment, with expectations that federal layoffs and funding disruptions in the coming months will have an even greater impact. Today's stock pick is TS Lines, stock ticker 2510. TS Lines is a container shipping company focused on the Asia Pacific region. In terms of fleet size, as of January 1st, 2024, it ranked 21st among global container shipping companies with a market share of 0.3%. As of December 2023, it ranked 6th among container shipping companies focused on the Asia Pacific region with a market share of 2.3%. The group's container shipping network covers 21 countries and regions worldwide, including 56 major ports. In the Asia-Pacific region, it operates routes covering 16 countries and regions, specializing in frequent route services originating from China's Greater Bay Area. The group employs a flexible business model, enabling it to adapt to constantly changing market demands. As of April 30, 2024, the group operated 9 independent route services, 22 joint route services, 15 route services through slot exchange arrangements, and 2 route services through slot chartering arrangements. In terms of its fleet, the group owns a total of 46 vessels, including 36 self-owned vessels and 10 chartered vessels, with a total capacity of 11,100 111,011 TEU. The fleet primarily consists of smaller vessels, each with a capacity below 2,000 TEU, allowing access to most ports in the Asia-Pacific region and offering greater deployment flexibility compared to larger vessels. The average age of its self-owned vessels is approximately 3.5 years per vessel. Deploying newer vessels plays a critical role in reducing unit operating costs, thereby enhancing its competitive advantage in the market. To meet future demand, the group has ordered three 7,000 TEU vessels, with one scheduled for delivery by the end of 2024 and the remaining two expected in 2026 and 2027, respectively. Additionally, it has ordered two 4,300 TEU vessels and three 14,000 TEU vessels, all slated for delivery in 2027, which can be flexibly deployed across multiple trade routes. The group will announce its full year results for the year ending December 31st, 2024, along with the proposed final dividend, if any, on March 28th. Earlier, the group issued a positive profit alert, expecting a profit attributable to shareholders of no less than 270 million US dollar for the 10 months ending October 31st, 2024, a significant increase of approximately 3,700% compared to the 7.1 million US dollar recorded for the same period in 2023. Consequently, the board anticipates that the profit attributable to shareholders for the full year ending December 31st, 2024 will see a substantial increase compared to approximately 20.7 million US dollar for 2023. According to the group, the significant profit increase for the 10 months ending October 31st, 2024 is primarily driven by rising freight rates due to ongoing supply disruptions from Red Sea rerouting, as well as increased shipping volumes and capacity. Recommended buy price 465 Hong Kong dollar, target price 505 Hong Kong dollar, stop loss 4.45 Hong Kong dollar. I personally do not hold the aforementioned stock.